China's banking system is failing. I'm your host, Steve Van Metre, and thanks for joining me today. And things in China have gone from worse to dire as the banking system is starting to collapse under the weight of the property crisis. And the People's Bank of China is trying to step in to save it, but they may be too late. Let's over to Bloomberg, where we picked today's story up as China seeks to stabilize the property crisis as PBOC urges lending. And the banks cut a key reference rate for mortgages by 15 basis points following last week's cut. And $29 billion of special loans can now be channeled to cash-strapped developers. The 5-year loan prime rate or reference for mortgages was reduced by 15 basis points after being cut by the same magnitude in May. The People's Bank of China on Monday urged lenders, especially major state-owned banks, or threatened them more likely to boost loans to the real economy. This move follows Friday's announcements of special loans being offered to property developers in a program that could be worth up to $29.3 billion. And the key here to understand is the People's Bank of China, the Chinese government, are not doing these things because they need to stimulate the economy. They're doing it because the economy is crashing and they're trying to stop the crash. I want you to think of it from that perspective. This isn't a case where there's just a mild slowdown that needs a boost. This is the thing. The banking system is imploding. And China is taking drastic action to help a real estate market beset with problems as home sales continue to plunge, property investment is contracting, and cash-strapped developers are struggling to complete projects as home buyers are boycotting mortgage payments, the one factor that nobody can stop. And the PBOC also cut its 1-year loan prime rate on Monday, again following last week's cuts, lowering it by a smaller expected 5 basis points, the first decline since January. The drop in the LPRs followed the central bank's surprise move last week to lower the rate on its 1-year policy loans by 10 basis points. So now one thing we hear in the U.S. is that, oh wait, when the Fed starts to pause or even cut, well, that's going to be really bullish for the economy. What I want you to understand is when central banks start to cut, it means things are bad. And when they continue to cut, particularly shortly after already cutting, it means things are really bad. And if China goes down, well, that's going to take Europe and the US and the rest of the world all down with it. And while borrowing costs could help spur demand for loans, it's unlikely to reverse the sharp slump in confidence. Again, a key point here, that people don't want to borrow at these lower rates. And you ask the question is, why don't they want to borrow? Because the economy is slowing. The entire global economy is slowing. And when that happens, you don't borrow to invest. You go into survival mode. And that's why lower rates don't always work. And in this case, they're not. And banks are flush with cash, but are either unwilling or finding it very difficult to finance projects as credit demand weakened sharply in July, prompting some economists to warn of a liquidity trap in China, where low interest rates fail to spur lending in the economy. And this is a case where monetary policy fails. And that's what a liquidity trap is, my friends, is when central bankers lower rates to spur lending demand and nobody shows up to borrow. Save this for a future date when the Fed lowers rates again, and they will at some point, and nobody is there to do anything, and that means we'll be stuck in a liquidity trap, except for the world, that will be even worse, because when the global reserve currency is stuck in a liquidity trap, everyone's going to feel the pain. And the PBOC surprise suggested China's outlook is truly dire. As the central bank is fretted about inflation, a surprise rate reduction tells you where its priorities lie, which is in panic mode, as China's both contributing to and the victim of a faltering world economy, as I pointed out in this show, for a long time. And when the International Monetary Fund slashed its forecast last month and warned of the prospect of a new global recession, one of the biggest revisions was for China. And over the past decades, we're more used to China being a source of resilience when other powerhouses like the US, Europe, and Japan teeter. That's not the case now. Such lower growth in major economies reduces demand for products that China makes, compounding the challenge. And they're right. In the past, particularly in 2015 and 2016, what did we see China do? They pulled the global economy out of what was looking like a recession. And don't think the PBOC is done yet. Better watch what the bank does, at least as much as what it says. And that's a key point, because if the PBOC continues to cut here, it tells you that China's economy is far worse than we thought, and their head is spiraling down. And one thing that should spiral down with it is your portfolio. Put a link up here to portfolio show in the corner and description below. Let's continue on, because what does it mean if China collapses? Well, get ready. global recession is coming, as China's surprise data could spell recession, as the devil in the details leaves the central bank no choice but to ease. Markets should expect bad news if the crisis grows worse. Not sure how much worse it's going to be before it's all-out collapse. But for the rest of the world, arguably the most critical Chinese data point is the volume of imports. For years, it has been the world spender of last resort. Again, as we talked about in 2015, 2016, pulling the global economy out of the slump. But imports measured in dollars have tailed off, while exports are surging as the economy tries to get underway after COVID-19. And why is that? Because China is facing a dollar shortage, something our chief strategist, Jeff Snyder, talks about on a regular basis. In fact, if you want to know what Jeff thinks about anything, be sure to sign up for Markets Insider Pro. There's a link in the description below. Because when you curtail your imports, again, think of in dollars, it tells you have a dollar shortage because you're trying to hold on to the dollars you have. Because when China imports things, guess what? Dollars flow out, and you start to see the bigger picture here. Is China's economy isn't just collapsing because it got overheated. It's collapsing because there's a global dollar shortage. And that is hitting China today. It will hit Japan. It will hit Europe. And next, it will hit the U.S. As China's appetite affects the rest of the global economy most directly through prices of commodities, especially industrial metals. The main Chinese iron ore contract has suffered a massive fall since peaking in the middle of last year, while copper dropped sharply this year. Both were clear signs of a weak Chinese demand and a dollar shortage. It's not long since problems for the Chinese economy were regarded as a positive for the rest of the world, because these would prompt another big credit-fueled stimulus. But if indeed the PBOC is stuck in a liquidity trap, they're not going to work. But without sufficient demand for credit, any monetary stimulus could be like pushing on a string. Again, stuck in a liquidity trap where no matter how low rates go, people don't want to borrow. Let's continue on, because Chinese authorities for years have prioritized their desire to avoid a Lehman incident, and clamping down on the property developers is part of that effort, and it looks like they're headed to one anyways. But it's coming at the cost of mortgage strikes, something that nobody could predict would happen, which raised their own risk of a systemic financial crisis. And now let's look over to Korea, who's facing similar problems, as Korea's exports close to stalling as the global economy cools. Because the story in China isn't just about China, it's about the entire global economy. Everybody is slowing simultaneously. Everybody's dealing with a dollar shortage. It's only going to get worse. As semiconductor sales fall after what we're told was a massive shortage, while exports to China, key point, drop as well, and pressure is building on a key barometer of the global economy, as South Korea's early exports barely rose in August as geopolitical risks and central bank tightening weighed on the world economy, and daily shipments increased 0.5% on average in the first 20 days of the month compared with the year earlier. Meanwhile, total exports advanced 3.9%. Key part here is chip sales declined 7.5%, and shipments to China dropped 11.2%. Remember, we had a chip shortage. Soon we're going to have a chip glut as global factory operations are cooling. The global economy is coming down from its peak and bringing down, along with it, demand for semiconductors that did particularly well during the pandemic. And then that turns to the U.S. And in the U.S., things still look pretty good. And everyone still thinks the U.S. is this island of safety. But remember, as the world's biggest consuming nation, we're kind of last on the list. You see the problem start with the big exporters and then eventually get to the big importers. And today we have the Chicago Fed National Activity Index telling us that the U.S. economy is in stall speed, right at trend, as the indexes point to a pickup in economic growth in July. But over the last 3 months, the moving average, which the Chicago Fed says you should follow, was unchanged at minus 0.09% or 0.09 in July, indicating that we are growing at trend. There is no major growth story here. And when we look at this, we see the diffusion index, which is also a 3-month moving average, it's up to minus 0.05. Again, a print of zero tells us the U.S. economy is growing a trend. That's not what's supposed to happen. We're supposed to be growing massively here. And now all of a sudden, if we're last 3 months are flattening out, where does that tell us we're going? Well, it tells us When we look at the Chicago Fed National Activity Index, shown here in blue, against the Wilshire 5000 or total U.S. stock market in red, it tells us where the U.S. economy is going. You can look at the relationship between these two. They're strongly correlated. And as the stock market has gone down on a year-over-year rate of change, it tells you that the U.S. economy is going to contract. The Chicago Fed is lagging here a bit, but soon to hit pretty negative territory and continue to fall. Now, what does that mean for the bond market? Well, normally you see a pretty nice relationship where the two, you see the interest rates on a year-over-year basis here tend to head lower, leading, of course, the Chicago Fed National Activity Index down. But now we see rates are higher. And what does that mean? Who's right? Does that mean the U.S. economy is going to rebound back? Or does it mean rates are going to collapse? Well, what it means is rates are going to collapse because market participants perceive that there is demand for higher rates. They want to sell bonds, they want to drive rates higher because the belief is someone else will borrow at those levels. But we've already shown on this show there isn't demand for those higher rates. And at some point, that means rates are going to catch down to where the Chicago Fed National Activity Index is headed and where the stock market's gone. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.